Welcome back. We have a pleasant set of results to handle now. Bank of India's third quarter numbers came in fairly decent. What stood out for me, at least, is that the bank posted a 16 basis point rise in its net interest margins quarter on quarter. That's not easy in a quarter when there was a rate cut in December, remember. So the other things that stood out for me, loan growth at 13.6%, deposit growth a little lower at 11.6%. Well, it looks like loan growth is going a bit too fast, but importantly, they're all within the guidance. The market has given a decent amount of thumbs up. Well, today it's given a thumbs up to all stocks, but Bank of India also gets a thumbs up for these numbers. There it is. A decent 5% gain is not something you often see after the banking results. Remember when ICICI announced its numbers, it was not greeted with such a big thumbs up. So what's going right for Bank of India? To understand that, we are joined by Rajneesh, Karnatak, Managing Director and CEO of Bank of India. Good morning, Mr. Karnatak. Thank you very much indeed for your time. I am very impressed, I guess the market is, by the rise in margins. And what is impressive is that there was a rate cut, and even then your cost of funds your yield on advances has not fallen. I mean, don't you have EBLR loans linked to the repo? How come your yield on advances did not fall, although there was a rate cut?
Yeah, thank you, Lataji, for having me here, and a very happy new year to you and all the viewers of CNBC. So yes, we have been able to maintain our margins, in fact, improve our NIMs, global NIMs from 2.41% to 2.57%. If you see the data, our yield on advances, as you rightly said, have they are at the same level at September numbers at 7.81, but our cost of deposits we have been able to bring down. So our cost of deposit as on December is now 4.77 only, and the difference between the cost of deposit and yield on advances was 3.04% as on December, which was 2.96% as on September. So we have improved it by 8 basis points. This has helped us improving the net interest margins overall. As your question with respect to specific question with respect to how we have been able to protect our this yield on advances, there I would say that we have done a lot of churning in the corporate advances and low yielding advances, which were AAA advances to PSUs, which were at very low rate in repo. There we have churned them and we have gone for AA advances where the margins were better by 20, 25, 30 basis points. So that has helped us in protecting our yield on advances, and the full impact of the repo cut which happened in the 5th of December has not come for the full quarter. The impact was only for 22 days. The full impact would be coming for the entire system in this quarter, in the Q4 quarter.
Okay. That explains. You said you churned your portfolio in favor of what and against what?
Yeah, that was in favor on the rate of interest only. It was in the EBLR only, the repo rate linked AAA rated borrowers. We shifted towards AA borrowers, where the rate of interest was much better from 25 basis points to 40 basis points.
Fair enough. Okay, I got that. Let me come to the cost of deposits now. That has fallen by 8 basis points. But, you know, when I looked at your investor presentation, you are having actually a very big growth in bulk deposits. One would normally think that will push up cost, isn't it? How come you manage lower cost in spite of having higher corporate or bulk deposits?
So just to share with you the data. So if you see the weighted cost of our retail term deposits, it is higher than the weighted cost of the bulk deposits by nearly 14, 15 basis points. So in fact, the bulk deposits are cheaper than the retail term deposits. Though retail term deposits have grown by 14% and we are a franchise of around 5,500 branches, we would always be growing our retail term deposit. But to give you a sense, in Q4, the average cost of those deposits was higher than the bulk deposits.
You know, will you run into an LDR problem? Because your deposits are obviously growing a little slower, 2 percentage points slower than your advances. As well, you are already relying on bulk deposits. So do you worry that you may not be able to keep up this pace because of deposits, or at least retail deposits being a problem?
Yeah, yeah. So we have a very nuanced approach as far as the LCR and other things are concerned. To just give you a sense, if you see our presentation, our deposit growth in absolute terms has been more than the advances growth. So our deposit have grown by around 92,000 crores, and our advances on a YOY basis have grown by around 81,000 crores. So one point is that our credit deposit is growing at a faster pace than the advances, though in percentage terms the advances is growing higher, but the deposit is growing at a faster pace, number one. Number two, the fact is that even though our CD ratio is at around 82%, our LCR is quite comfortable and well above the benchmark of 100% set by the Reserve Bank of India. That is the second point. Third point is that our this retail term deposits are growing at a healthy 14%, but our bulk deposit, as you rightly said, has inched up to 15%. However, our in the entire domestic deposits, 85% of the domestic deposit constitute retail term deposits and CASA deposits. There also, if I give you a sense, the bulk deposits, there also we are growing quite healthy in the bulk deposits also. And definitely with the credit growth we are having, 15% on the domestic side and global credit deposit of 13%, definitely there will be more requirement of deposits. And with the structural shift which is happening on the deposit, where CASA is not growing for the banking system and more reliance is on the retail term deposit and bulk deposit, definitely there will be some increase in the term deposits for the bank because we have to sustain the growth of the advances which is happening in the system.
Fair point. So how do you expect your margins to trend therefore? It looks like we are at the end of the rate cutting cycle. And maybe now your, older deposits will start getting repriced also. How do you expect, what is the margins for this quarter, fourth quarter? What is the guidance for FY27?
Yeah, as far as the margins are concerned, so now the present margin that we have, we feel that we'll be able to sustain this margin in this quarter. And with the repricing in the term deposit, which is happening quite with pace, we think that the margin should bottom out in the Q4, and after which there should be improvement in margin, provided there is no further repo rate cut.
Okay. Well, there is a small rise in slippages because of that road asset. Can you give us a sense of how the SMA, I'm trying to read your investor presentation quickly, but anything in the SMA 1, SMA 2 that we should worry about? I think there is a marginal rise in the SMA 2 assets. Is that anything to worry?
Yeah, so there has been a 2 basis point increase in the slippage ratio. That is because of one road asset which has gone into NPA. But overall, I can confidently say that in the Q4, our fresh slippages should be the same level in the Q3, which have been there. As far as the SMA book is concerned, see, SMA, we have been able to reduce 5 crore and above from 6,400 crores to around 5,500 crores. And it is only 0.75% of the overall book. So SMA2 number, if you see more granularly, there are basically majority of the SMA2 is putting in the corporate book, which are 3 PSU accounts, which are there, which have now rolled forward towards the SMA2 category. But we have a state government guarantee over there. Okay. And we are quite hopeful that the slippage will not happen in these accounts. Okay. But as far as the overall SMA is concerned, yes, there is SMA in retail, MSME and agriculture book. But this is a normal SMA, which is there, SMA 012 in the RAM book. And there is not much of a concern over there. All right.
I'll just tell my viewers, we are talking a bit of jargon. SMA2 are loans which have not been paid back even 60 days after the due date. SMA1 are loans that have not paid back 30 days after due date. So SMA2 has gone up slightly. Last quarter for Bank of India, it went up by 0.29%. In the third quarter, it has gone up by 0.57%. So that's why I asked this question. But thank you, Mr. Karnatak, for that. The other point I wanted to ask you was, what is the sense you're getting in terms of where the best growth will come? And therefore, where will the margins come from?
Yeah, as far as the best growth is concerned, we are targeting, frankly speaking, our RAM credit. That is where the margins are. Retail, MSME and agriculture. There is where the margins are, number one, and where there is diversification in the portfolio also, and we are able to spread our risk also. So our RAM book is growing at around 18% on a YOY basis. If you see, retail book is growing at around 20% on a YOY, MSME book at 15%, and agriculture book at 16%. So that is where we are targeting. Presently, our composition of advances is that 58% is RAM book and 38% is the corporate advances. In the long term, as a strategy, we want that our RAM book should be at around 65% and the corporate book at around 35%, because that is where we feel the margins will be there going forward.
Okay. You're doing a steady recovery of about 1,000 crores to 1,200 crores. A year ago it was 1,200 crore. Last 2 quarters you've been doing about 1,000 crore. Is there a lot of more recoveries can we expect in Q4 and next year?
Q4, definitely we have a good pipeline for recovery. Nearly 2,000 crore of recovery we should be showing in Q4.
Oh.
And it would be much better what we have done in the Q3. So if you see the total recovery which has happened in this quarter, Lataji, so it has been around 1,500 crore, which includes the recovery plus the UCI and the URI, which we call the unrealized interest. There also recoveries happen when we do the one-time settlement and other kind of things. So 1,500 crore has been the gross recovery, cash recovery, and it is 1.3% of the fresh slippages. And with the around 2,000 crore of recovery, cash recovery we are expecting in this quarter, our number should be even better, considering the fact that we will be able to contain the slippages at the same level.
Oh, that's good to hear. Very quick last question. Has there been any discussion on consolidation? Should we expect some news, budget or later? What have you been told?
No, nothing, no news with us.
No news at all. Okay, ROE, any guidance you can give us? ROE or ROA?
So ROA, we are at 0.96% and we are very close to 1%. We should be touching 1% in the Q4 quarter, but for the annualized ROA, I would say that we should be somewhere around 0.91, 0.92% for FY26. And going forward, yes, for FY27, we are targeting a consistent ROA growth of 1% in the coming quarters.
Okay. All right, we'll leave it at that. So out of time. Thank you very much, Mr. Karnatak, for joining us. The markets have given their verdict, a 5% gain in the stock. The overall markets, after showing a brilliant start, has seen a little bit of profit taking, but that is normal after 1 hour of trading. It looks like we're in for a good day for the bulls at long last. On that positive note, wrap up on Bazaar. Chart Pass is coming.